This month's recording of Fidelity Focus follows a significant week in the US. The Republican Party have secured a decisive victory in the 2024 US elections that will see Donald Trump back in the White House and the GOP winning the Senate. The House of Representatives have not been decided at the time of filming. We can start off by asking the big question: what is the likely impact of a rate sweep on markets? Markets have generally moved significantly in response to the results, with expected policy winners outperforming. But election results often matter less for markets than many would believe. At Fidelity, we prefer to look through the noise to focus on long-term fundamentals, and judging from the past few election cycles, markets tend to do well over the medium term regardless of election outcomes. For now, the fundamental backdrop is still healthy, coupled with the start of a new interest rate cut cycle. Both factors can be powerful forces supporting the market. But expectations for looser regulations and easier policy stance from the GOP does mean that reflation risk is back on the cards, and this can alter the trajectory of monetary policy significantly next year. While we are still likely to see further rate cuts through 2025, the pace and magnitude will depend on upcoming policy changes and economic data points. These are areas we will continue to monitor. We are seeing several opportunities that may arise from new Republican policies. With expectations for policies that support lower taxes and deregulation of the financial and energy sectors, equities should be well supported. One area that appears the most compelling is small to mid-cap stocks. We have been highlighting this asset class for a while now, as valuations are attractive both against mega caps and their own intrinsic values. Strategies with a small cap bias, in particular, are likely to benefit from the renegotiation of corporate tax rates. For investors looking for opportunities, it is important to seek out high-quality companies that focus on long-term profitability and have the flexibility to adapt. As policy developments in the US unfold over the coming weeks, some volatility can be expected. Investors can benefit further by looking beyond the well-owned sectors to uncover gems and to diversify portfolios. Another area we're watching, particularly as investors based in Asia, is the part of the global market that is likely to suffer from higher tariffs. At face value, the proposed measures could significantly impact Asian economies, but we do believe that it is too early to draw overly extreme conclusions. Negotiations that could drive the eventual implementation of these tariffs are still unclear. Outside of geopolitical developments, there are other positive developments happening in Asia. Policy in China has turned much more supportive, with a clear focus on stabilizing the economy. We have seen a series of easing measures in recent weeks, including the 10 trillion renminbi local government debt swap program announced at the recent NPC. We believe this will unlikely be the last of these easing measures, and we'll be watching for more clues in December. Elsewhere in Asia, we're still seeing interest in Southeast Asia, as the region has largely been a beneficiary of US Fed rate cuts, and for manufacturers looking to diversify their supply chains to the region amidst US-China tensions.